Those are ratios, and now we're going to look at three slightly different angles of analysis: trend, common size, and percentage change. Trend basically means time. Looking at a company over time, or looking at a company and or industry over time. Common size means that we're going to compare all the analysis against a benchmark. And we'll look at the balance sheet and income statement because the benchmarks are different. And finally, percentage change looks at one line item, like sales, and then looks at changes in sales, again, over time. So first we'll look at trends, and what you see here, again for Microdrive, in blue here, represents that they were rising in terms of their ROE. However, starting in 2015, they're sliding. Whereas the industry has been rising, and then it had a little bit of a dip in 2015, but rose yet once again. So the phrase, "a picture is worth 1,000 words," is applicable here. With a simple line graph, we're able to see trends of the industry versus the Microdrive for 10 different data points. So it's a very handy way to help you analyze and see what's going on. Let's look at common size balance sheets. And in the case of a balance sheet, remember that we divide everything by total assets. And then that way, every percentage above it talks about the composition of assets. So let's try it out. So here we have the industry composite in column C versus Microdrive for 2016 and 15. We divide everything by the total assets, and we end up with this. We see total 100% for all three being the same. Now have your eyes look up and we'll see the difference. So between 2015 and 16, you see our cash balance at Microdrive went down. We see our short-term investments go down to zero. We see an increase in receivables and an increase in inventories. So these are all concerning trends because we're losing liquidity and we seem to be growing our asset base. And finally, we look at the PP&E and we see it's fairly flat at about 56. So we see a trend when we compare 2015 to 16 for Microdrive. Now, if we compare these two columns, Microdrive versus the industry, we see what we have noticed before, which is the amount of assets for the Microdrive is below an industry average. We also see that the total assets here for industry is 42% versus 43%. So we have higher assets necessary to run the Microdrive business than the industry at large. On the liability side, once again, if we start with Microdrive year to year, we start AP is going down, which is favorable. But look at our notes payable. It's gone from 4.3% of assets to 7.9%. That's a pretty major increase in our debt load. And then we also see here that our equity went from 43 down to 41, which is a concern that we're now reducing our equity and therefore increasing our liability. Now, if we go look at these two columns of industry versus Microdrive for a like period in 2016, we see similar trends to our ratio analysis where our debt load is higher than the industry and our equity is much lower than the industry. So common size is a good technique to give you insights about the composition of assets and also the amount of leverage carried by the company. If we use common size now for an income statement, remember that what we divide by is not total assets, but total sales. And so if we transform the industry and Microdrive's financial statements by dividing each year's numbers by those year's sales, we get the following. Once again, let's look first at the trend for Microdrive, looking at these two columns. We see that as a percent of sales, our income has gone down from 5.5 to 4.4. That's not good, right? We would hope that as we grow the company, that our profitability would improve. We also see that that's an issue at the EBIT level, where the profitability from operating earnings also slipped. And now we shift gears to look at the industry versus Microdrive, and we see the same trend where net income is less for Microdrive than the industry. The operating income is less for Microdrive and the industry, and of course, the pre-tax is also less. So this is a very quick way to see and to quantify the lower profitability of Microdrive compared to itself from year to year, and also compared to the industry at large. Percentage change is a very simple calculation. It's just using 1 year compared to another year. So if there are years like 2015 and 2016, the change is a difference, and then the denominator is always your base year. This 5% number that we see for percent change in sales is derived by taking the change in sales, in this case it went up, divided by the 2015, which is the base year sales, and that ratio turns out to be 5%. So that means sales went up 5%, but look what happened to costs. You would expect that the cost would rise proportionately, but when costs are rising faster than sales, that's trouble. And that's what happened here. That's part of the reason for the inferior performance of MicroDrive from year to year, is because their sales are not growing as fast as their expenses. And when that ripples all the way to the bottom line, we see a negative change in the net income available to common shareholders, yet a negative trend. And finally, we're going to look at the benchmarking. Here we're going to move out of MicroDrive and look at Apple Computer. And against Apple Computer, we'll compare it to the computer hardware industry at large and then the tech sector overall. And so we can look at all these ratios that we've seen previously, PE ratio, quick ratio, etc. And it's pretty simple once you have the numbers side by side to compare them and to make assessments.